We the Property Brrrrothas. The Property Brrrrothas.
What's up, everybody? How are you doing? It's us, the Property Brrrrothas. I am your host, Jordan, along with my co-host, my cousin, the numbers ninja himself, Drew. What's cracking, man?
What's up, man? How you doing?
Dude, good morning. I'm going really good, man. I got my coffee here. Go Niners. Bang, bang. Niner gang.
Bang, bang, bang. Niners gang,
And
man. All right.
we are going to talk about, we got a great episode, man. We are going to get into the refinance in the BRRRR strategy. People. And if you've been kind of following along in our journey, we kind of broke each step down, each aspect of the BRRRR strategy. We talked about how to build your team first and foremost, right? How to structure that and get those boots on the ground. I think we talked about that in episode 2, Drew, right?
Correct me
if I'm wrong. We talked about the buy phase. We got into, how you want to buy distressed properties and buy undervalue. Okay, I think we talked about that in episode 3. And then we got into, once you rehab, how to avoid those big rehab mistakes. Don't do what we did, right? Be better than us. We talked about that as well. And then our most recent episode, we got into how to rent it out, how to find that tenant, place that tenant, right? And get that income coming. So now, Drew, this for me personally, this is the funnest part in the BRRRR strategy is the refinance. So talk to the people about what we can expect today. What are we going to be covering and, just what to look forward to.
Yeah, absolutely, man. So this is the third R, repeat. And this is one of those things where,
refinance. We're refinancing. We're not repeating yet. You got ahead of the game.
I want to repeat.
Okay.
Can we repeat? All right. So today we're talking about refinance, and that's the step that either sets you up for the repeat or traps your cash in a deal. So super, super important that we refinance properly. So hopefully, in this episode, we'll be able to expose you to some of the tools and tricks and of the trade that we have come across in, our experience with refinancing.
Yeah. So we'll be kind of pulling back the layers, man, on, how to pull your cash out, how to choose the right loan types, about the appraisals, okay? How to get organized for that and trying to get that very important ARV and hitting that number right and structuring, your LLCs to accept certain types of lender and loan products. So with that said, man, you ready? Should we jump into it?
Yeah. So like I said, the refinance is what makes that BRRRR strategy a true wealth tool. When you buy at market value or under market value, that's what we're trying to do. And then you rehab right, and then you rent strong. Now you're ready to unlock all that equity. So, what I kind of want to start with is, what are some of the biggest mistakes that we see when you're trying to refinance? So one thing would be waiting too long and losing momentum because all those comps change, right?
Yeah.
So
it's a moving target, huh?
Yeah, it's a total moving target. It's like, okay, today the comps may be, super high, but next month they could start to drift down, especially if you're stuck in a stagnated marketplace where not a lot of stuff is happening, more inventory is popping up, less buyers in the market. So, there's less opportunities for competing for those different properties that are out there. So comps change, they can go down. We also have, the opportunity to refinance too fast before the asset has actually stabilized. So what that means is typically banks have a seasoning period, right? So a seasoning period would be the time that you bought, from the time that you bought the property to when you're trying to refinance. How long have you had that in your asset, right? So typically a bank wants to see at least 3 months, right? It's better if they see 6 months. It's better if they see a year, right? Yeah. So, and the difference to that would be possibly 5% of cash in your pocket. So, 3 months is 75% ARV typically is what a bank will give you. It might even be 70% if you're beginning, man. That's something that That
let
sticks.
me stop you there, man. Let's peel that back a little bit. So you're talking about 70%, 75%. So can you
Mhm.
clarify for our audience, what does that typically entail? So 75%, you're talking about the loan to value. So can you peel that
Yeah.
back a little bit?
Yeah. So, we just spent all this time. We like I said, we bought our house right. We forced some value by doing a great rehab, right? And
Right.
so when we're looking at we want that appraisal to come back at a higher ARV, after repair value, right? So the bank is going to give you 70%, 75%, or 80% of that ARV, depending on one, your experience, and two, how long your property has been seasoned, and three, does the rent support the payment of the amount that you're pulling out?
Good. So, like, just for round numbers, right? If our ARV is $100,000, right, and if we're at 3 months and we can only pull out 70%, that means the bank is only going to give us $70,000 of
Right.
that ARV. And then at 6 months, maybe they'll give us 75% or $75,000, or at maybe longer, 9 months to a year, they'll give us 80% or $80,000. I got that right?
Exactly. Yeah,
Okay. Cool.
exactly.
Cool. Cool.
So that is, and what's interesting is that as the markets kind of fluctuate, uh, 80% are becoming unicorns, right?
Yeah.
They're
Yeah.
becoming unicorns.
Yeah.
Most of the banks that I've talked to are only lending out 75%, and that's even for people who have experience. So the other thing that's interesting, since we're talking about you know biggest mistakes, is you're in an unstable or unpredictable marketplace, like what we've been seeing lately with tariffs, right? So we got tariffs on one day, we got tariffs off,
Yeah.
right? So
What's he trying to do, man? Yeah. What's DT doing?
I don't know. I don't know.
I didn't even look what he did today.
Hey, hey, this is not a political show. We have zero opinions.
Yeah.
With that said, but we don't have opinions, but we also have observations, right? So
Right. Right.
when DT did, pump those tariffs into the market really didn't know how to react, and it was an adverse reaction that caused the interest rates to go down. I saw it as low as 5.5% for like, an hour or two. And I was like,
Right.
oh, do I have any properties that I need to refinance? Right. It's hard to pull the trigger and lock something in like that. But
Yeah. In an
um,
hour. Yeah.
right. But it did go down that far. And now today, a couple days ago, I got a term, a rate quote for like 7.5%. It's like, dude, like that's 2 points difference, right?
Yeah.
So in an unstable or unpredictable marketplace, you got to be aware of what's going on. There's because of the unpredictability,
Hmm.
I'm trying to predict what I'm going to be doing as some of my rehabs are finishing in 2 months, right?
Yeah.
Do I
Right.
pull a long term, a 30-year loan out, or do I pull out, a HELOC, which is something that we're going to talk about later on, which is
Yeah.
a really cool tool. But yeah, that's some of the biggest mistakes that we see right now.
Yeah. And, just to, kind of piggyback on that, man, personally, I did a refinance, went through a BRRRR last year. This time last year, I was in a rehab. But when it came down to kind of seeing that finish line, right, we are like, all right, cool. Let's get this refinance. My biggest mistake was, I over anticipated, or maybe I was just a little too confident that I was going to hit that ARV number. And at the end of
Yeah,
the day, despite what your numbers say, despite what the comps are saying, right? At the end of the day, it is the opinion of another person. And
right.
depending on, what you get, who you get, what kind of mood they're in, it can really shake up or break up, how you really, attack that final refinance.
So what
And
happened on your appraisal
so
last
for
last
me,
time?
man, I was looking to get, all my numbers said that I would get like 275,000, right?
Yeah, yeah.
At the end of the day, once this appraisal came back, he came back with like $30,000 less of his opinion value. And I was like,
And how much was your
whoa,
rehab?
whoa. So my rehab, dude, my rehab was over 100K.
Right.
right? I bought
And
the
you already had
property,
money in a play, and you had
dude.
money in a deal, right?
Yeah, I had a lot of money in the deal. I bought the property right. I bought it way undervalued, but I went over budget, man. And we talk about that in our rehab episode about staying in budget. But I went over budget, man. But anyways, so I had all this money in the deal. I was it was trapped in, and I was really, really, really hoping to get this to 275 number. And that's
Mhm.
another big mistake, right? Is hope. Right. You
Yeah.
can't hope, right? You just got to be conservative and with these numbers. So, long story short, I know too late. I ended up having to bring money to the table
Yeah.
because that ARV that the appraiser gave me, it was far short than what we were anticipating. And so that means that the bank can only lend based on what the appraiser is appraising. So
That's
I had
horrible.
to bring money to the table, and therefore my BRRRR didn't pencil out. And
Yeah.
so, me and
Well,
Drew were
now,
talking a lot of times, man. And I just was like, dude, I'm just going to keep it and we just going to make it work. And so far, so good, it
yeah.
is what it is. But, we chalk that up to, lessons learned.
Yeah. So while the appraisal is in someone else's hands, right? There are certain things that we can do to help to almost plead our case, right? To position our property as, hey, listen, I don't know if you know, but we did this. Here was the scope of work, right? Here are the
Yeah.
before and after pictures, right? Here are the rehab receipts. Here's the lease agreements. Here's the utilities and the
Yeah.
permits, right? Here's everything that we have done
Kind
to
of
this
getting
property.
organized.
Yeah. And so, obviously sometimes it's hard to get all that information, but I think that didn't we develop a tool
Yeah, we
to
did
help?
develop a tool.
Yeah.
If only I had this tool a year ago,
Right.
maybe life would have been a little bit more easier.
Yeah. Easily.
But for you people, ladies and gentlemen, we have developed a tool. It's a little spreadsheet that we put together that, over the course of our experience, we've been asked all these things when it comes to building your refinance from lenders. Okay. And
Yeah.
these are just some of the things that they ask. So, Drew, what are we looking at here on this spreadsheet?
Absolutely. So, like Jordan said, when you're going through the appraisal, actually the actual loan process, the lender is always going to be asking you some random questions like,
Mm-hmm.
"Hey, when did you guys first start renting this property?" It's like, I don't know, or "Hey, where do you have the Alta?" It's like, what's an Alta,
What's an
right?
Alta?
Where do I find that, right? So typically when we get into these deals, you have a fix and flip loan, and they want to know the details about that loan. What was the amount that was actually lended? And so you have to have all these different things available on a whim. So we created
Yeah.
this sheet. I created this sheet based off of a lot of the questions that I got from these so easy peasy. You got your before pictures. You could post a link to your Google Drive folder, right? With the before
Right.
pictures. You've got the after pictures. Scope of work is huge because, again, you're trying to paint that picture for the appraiser of what exactly has been done. They can't see in the walls. They don't know if you replaced the plumbing, or they don't know if you replaced the electrical, etc. So having that scope of work from your contractor, I typically grab the contractor's agreement and pop it right there. It's easily accessible. Property card, property zone, those are things that you could probably get from your city's website. And what I'll do is I'll download that property card, I'll put it in a Google Drive and have a link right there that has a lot of really good information like tax information, the previous
Yeah.
owner, how large your lot is. Sometimes it'll even have some sort of like floor plan in that property card. So it's pretty cool. The other thing that I like to do is have the purchase loan, all the information about that loan, the date, the lender, the account, what's the monthly payment, what's the term. I also have a link directly to the payment portal. And like I said, that final closing sheet, that Alta, right? And then who is the contact for that loan, right? So having all this stuff at your disposal is it's invaluable, right? And I typically will have a tab for each and every one of my properties so that I can quickly jump to that property and get the information that I need. The insurance carrier is huge because, I have a company that I use called ElmShare. A lot of the insurance companies will automatically renew your insurance, and
Mhm.
so that's kind of a luxury. ElmShare, they're like, hey, I want to make that broker money, so I'm gonna resell them a policy every year, every time it
Yeah,
comes up, and it's like, dude, come on now. But
terrible.
if they don't, let's say, for example, they forget to reach out, right? You need to know how long that insurance policy is in place, because if your insurance lapse, my gosh, that becomes a whole nother situation. Your
Yeah,
insurance is going to go up, right? And
yeah.
your lender's going to get frustrated because the house is not covered, et cetera. So
Right.
again, all of
Yeah,
this stuff,
and you're at risk, right? Without being
you are you are at
covered, and you
risk.
have a lapse. So that's where you
Yep.
have that term length right there. Yeah,
Yeah. So
perfect.
anything that has to deal with, your loan or your house, I would put it on a sheet that's easily accessible, just like this.
Yeah, beautiful, man. And just really quick, I want to touch on, the reason why we have purchase loan, refinance loan, ladies and gentlemen, is because Drew mentioned this in the beginning, right? We are typically purchasing these properties distressed with what's called a fix and flip loan. Okay. However, that's not the only product. Maybe you're getting it from a private lender, right? Maybe a family member is giving you some cash to take down this deal, or a hard money lender. Uh, Whatever the case may be, these purchase loans come with a high interest rate, right?
Right.
And so they typically last for a short amount of time, anywhere from 3 to 6 months.
Right.
And they have large, typically interest only payments while you are in the project, while you are in the rehab. So that's why it's so important to get through that rehab as unscathed as possible, so that when it comes to refinance, now you are refinancing out of that purchase loan. You are paying back your lender with the refinancing money. And if you are doing it right, which is what we're going to talk about, you are
Right.
taking money out of the deal where you can either pay yourself back, get that money that you put in, and then you can recycle it. And so that's why we have purchase loan and refinance loan. So, if this is something that is useful for you, let us know. We might drop it in the on our website. Okay,
Yeah.
maybe give us a comment if you could use something like this. So yeah, man, I think we'll maybe segue to the different loan structures, right?
Absolutely, man. So, when we start to talk about lenders, typically traditional loans is where people start. They had experience with that. Maybe they took out a traditional loan for their house. And what that typically looks like is you're using your personal credit to qualify for that loan, right? And what that means is you've got to go through your personal credit checks, you've got W-2 income, you've got tax returns, and it's always in your
Uh-huh.
personal name, always in
Yeah.
your personal name. And so at that point in time, you could obviously move it into an LLC later to protect your assets, but, you know, you're probably triggering a due on clause or due on sale clause,
Yeah.
which is, something that the lender could call the entire balance if they see that you did a deed transfer.
Right. Right. Right, absolutely. And so, due on sales clause, they typically don't happen, but be aware because they can happen. The lender can always, call that, but that's just something that you need to be aware. And that due on sale clause just typically means that, the lender, because they saw that deed transfer, they're going to call that whole loan,
Mm.
that whole balance, and they're going to be like, hey, you know, this transferred hands, you owe this entire, $180,000 balance. But like we said, just be safe. But it typically is not really heard of, but it can happen.
So how do you buy your house in an LLC, or how do you move it into an LLC? right?
So to move it into an LLC, that's a good question, is you want to do what's called a deed transfer. You get like a warranty deed transfer, and those are really easy to come by. You can call up your local notary.
Mhm.
And you're just going to seed the deed from your personal name into your LLC. Now, obviously, you have to have an LLC already put together, already structured. So if you don't have an LLC yet, go ahead and do that. All right, go get you
Yep.
an LLC.
So my question to you is, what if we want to avoid all of that? What's the other tool that we can potentially refinance into?
We can refinance into an DSCR.
Boom. That's what I was looking for.
DSCR. Yes, sir. Yes,
That's what
sir.
I was asking you a long time ago.
It took me a minute to get there. I'm over here multitasking.
You're like, you could transfer into a warranty deed and
It's hard work,
come on now.
ladies and
Let's
gentlemen,
go.
to be the host of this show, man. I'm multitasking too. But that's
Focus.
it.
This right here is the nook and cranny of
Yes,
what we're
sir.
talking about,
Yes,
brother.
sir.
This is
So,
what makes this work. Tell
yes,
us
sir.
about it.
Boom. Bow, 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 bow. Man, the DSCR, people, is the debt service coverage ratio, man. And this is
Say that.
the
Say
loan
that
product, the debt
faster.
service coverage ratio. And this is the type of product that we love to use when refinancing, even when purchasing, these properties. And so what this does, ladies and gentlemen, is it doesn't look at the lenders don't look at you necessarily as a borrower, quote unquote. They look at the income that your property is producing. And so, that comes back with the rent, right? And so you have to set that rent right. We talked about that in the last episode. And so the debt service, that's what that stands for, is how are you servicing your mortgage? And you're servicing your mortgage with the income that your property is generating. And so these can be bought in your LLC, right? And these can be you will typically get favorable rates, right? So Drew, if you want to pick up from there, my brother, go ahead. Talk to him a little bit more.
So like you said, you can close an LLC. The loan stays off your personal credit report. The process is faster. It's more asset focused. When you say that they're more favorable rates, the rates can be a little bit higher for sure than if you're putting it in your personal loan because, it is in the LLC's name. Now, you typically are, even though there are other products out there, you're typically the guarantor, right? So while it does stay off your personal credit, they're going to come after you if you default, right?
That's true. That is true.
That's the deal. You still need to have about 20 to 25% down. But if we are doing this BRRRR process properly, you've already calculated that. You've got that baked into your equation, right? And the other piece too is that you will have, not unlike, dude, I told you, wifey always says I sound like Mike Tyson when I'm doing these podcasts. I'm like stuttering through this whole thing. It's so ludicrous. But check it out. You will have some prepayment penalties typically baked into this. The banks want to basically say, hey, listen, I need to make sure I'm making a little money before you decide to go somewhere, right? So,
there you go.
so those
Everybody
are some
wants
things
their cut.
Yeah, they want their cut, right? But listen, if you're a BRRRR investor looking to scale, this is the option. This is the strong option. This is the beautiful thing because I know this is not our first rodeo actually on this episode. This is like our third take, right?
Right.
And check it out. Check it out.
Why are you putting us on blast?
One of the things that you said in the last take was that how many loans can you take out in your personal name?
Yeah. And that answer.
And I know I said in your personal name. I know it's you in your. How many loans can you take out in your personal name?
Well, that answer, ladies and gentlemen, is 10 as a single person, or 20 if you are a married individual.
Yes.
So, depending on your economies of scale, right? You might burn through 10 individually and then bring your spouse in, and then might burn through 20, traditional conventional loans quickly, right? Depending
keep in
on
mind too,
how fast you're scaling.
Like you say that on paper, you can, burn out 20, But the bank is probably going to look at you at the third or fourth or fifth and be like, I don't know if your income can really support all this.
Yeah, you
Right?
might be leveraged too high. Yeah.
Yeah, your leverage too high. So what this DSCR loan does is it opens the world up for scaling,
That's
right? Because
That's
it's
right.
built for this industry.
Right. Right. That's facts, man. That's facts, bro. And so one of the things that, the numbers ninja himself, Drew, developed was a spreadsheet to compare apples to apples, these DSCR products
Right.
with one another, because, not all lenders are created equally. Not all products are created equally, just like not all tenants, right? We got to do it with the lending product as well. We got to screen them. And so, we typically like to, run the numbers on a spreadsheet again, and then just kind of see, how it shakes out, right?
Yeah.
Who's offering us the best deal, who's got the least amount of fees, because Drew, don't they ask for fees, right? You talked about that, right?
Yeah,
They
they
don't.
ask for less. So let me break it down. I mean, built this spreadsheet so that I can look at the points that are being charged. So like you have points that are being charged by the lender. But if you're dealing with a broker, you also have points that they're charging on top of that too.
Yeah.
So a broker is someone who is extremely invaluable. I love my broker. His name is Ron, but I ain't gonna plug the name of his company because he owes me a new loan, and maybe next time. Anyways, so you got this broker who has access to all of these different banks, these different lenders, and based off, if you have a really good broker, you can go to that broker and say, hey, here's the scenario that I'm trying to do with this particular project. This might be a lopsided loan where you bought the property for $30,000, but the rehab is much higher, like let's say 70,000. Some banks, they don't like that at all, right? So, your broker can be extremely invaluable, but he's going to charge a fee. And typically it's no less than 1.5%, right? So if I have a $100,000 loan, he's making $1,500. And then the lender is also making at least 2 points, maybe 1.5, 2 points, 3 points. And then if you're trying to get a favorable rate, like let's say you have your heart set on, a 6.5% loan, but the rates are 7.2, they're also going to charge you points on top of that. So our spreadsheet takes into account all of those fees. Then you have underwriting fees like title and, transfer fees. And they always throw in this, I don't know why they do this, but they throw in this like dumbass, can I curse? I can't.
Say what's on your chest.
Hey, this dumbass legal fee. And I've seen it go from like $900 to like $2,500. And it's like, what you legalese it? Like, it's not like you haven't done this process 50 other times. Why you gotta legally, you wrote this. You probably had your lawyer write this. Anyways, I don't know, dog. I'm just
That's
telling
funny,
you, like,
man.
there's
That
so
is
many
funny.
fees. There are so many fees. So we got that. And then on top of that, you've got to look at your rate. So what is the rate? What are the insurance costs? What's the property management cost? What's your maintenance cost? And of course, the government wants a piece too. So what's your
Dude,
taxes, right?
dude.
So I have a column for each and every different loan
Mm-hmm.
and what those fees are, what the interest rates are, and then I also plug in the rent, right? And I'll share this with you guys right now. Right now, it's not ready for the public. It's too private. It's got too much private stuff in there. We need to make it more public, right? So
Yeah.
we'll create a little spreadsheet that you guys can utilize for your own comparisons.
Yeah, for
And that
sure.
just helps you to take it from the napkin to more of a formalized process to analyze, is this loan right for this particular scenario?
Boom.
Boom.
Boom. Well said, my friend. Well said, dude.
Boom.
So that brings us to maximizing your ARV.
Boom.
Maximizing it.
Is this where we get to show off all the stuff that we did to the house to the appraiser?
Yes, sir. Yes,
Yes,
sir.
sir.
This is where we talk about getting the maximum amount of value for your home. And so again, ARV stands for after, excuse me. Look at me sounding like Mike Tyson.
That's
After
ridiculous.
repair value. And that's the number that drives how much you can refinance, man. And this is what the appraisers are looking for. So, Drew, what can they do to really showcase the value and how they force the equity property?
So to influence that appraisal, you need to make sure that your upgrades are visible. You need to make sure your house is clean. You need to focus on the kitchens, the baths, the curb appeal. You need to add energy efficient features
Yeah.
where, like, think about this curb appeal. Appraiser walks up, there ain't no grass, there's dirt all over the place. You know, the
Mhm.
front of the house may have like buckets and mops and stuff like that. Like
Yeah.
these are first
Trash.
impressions, right?
Yeah.
Like
You
you want
only
to
get
make
one.
sure, yeah, you only get one first impression. So you want to make sure that that house is shining, right? You kind of want to, potentially. What I typically do, the appraiser is going to call and ask, "Hey, when can I come out and da da da? Da? Oh, which property are you talking about? Oh, the one over there on, on Richland. Well, yeah, it's going to be available on such and such date. Yeah, that's the one that we did. Blah 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 blah. Like do some
Oh,
shameless
that's
plugs
smart,
real
dude.
quick,
Yeah, that's
you know.
smart. Yeah, 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 yeah.
So like
That way you
now,
get it in his head, kind of thinking
yeah.
about it.
Oh,
Yeah.
I need to go and take a look at that. Oh, that's
Yeah.
where we did the granite countertops in the kitchen. Oh yeah, that one's a banger. That one looks great.
Yeah.
Whatever it
Yeah.
may be. Now you don't want to do that too much because these guys are hip to the game,
They
but
are. Yeah.
you do want to kind of prime the pump, so to speak. So
Yeah.
and call out some of the things that you're doing and what that particular project ultimately is going to be, right? and
Yeah.
and sometimes I've had conversations where the appraiser may even say, well, what value do you think is coming out of this? Like what are you guys aiming for? you
Yeah.
know
Yeah. Right.
and most appraisers don't do that, but yeah, that can happen. So that's
And I
that's
just think that this is another great, reason to have a spreadsheet like this, ladies and gentlemen, where you can have your before pictures, your after pictures, your scope of work kind of handy for you so that you can, especially if you have multiple rehabs going on at once, you can have it already organized and you can, tell the appraiser, like, this is what we did, you know. But,
yeah.
at the end of the day, it's their opinion. And so I think, you know, to throw myself under the bus, so to speak, again, a mistake that I did was, I kind of focused a little too hard on those custom features that, don't necessarily add value. Right. And, what do I mean by that? I mean that, maybe focusing on, I like lighting, right? And lighting is great, but you don't necessarily need a real nice chandelier,
Yeah.
right? Because based on the neighborhood that you're in, right? And based on the comps, if that's not what's in other homes in the neighborhood, and if that's not raising their value, then that's unnecessary, right? And so you're kind of throwing money in the wind, so to speak. And so some of the things that will absolutely increase your ARV, you know, 9 times out of 10 are the kitchen, right,
Yep.
Drew?
Yep.
Um, Bathrooms, and
Hmm.
particularly adding bathrooms or
Yeah.
adding bedrooms. So for example, right, this is why you got to buy right, is if you find a property undervalued and you see that it's got this big open floor plan, right, and it's only got 2 bathrooms and 1 bathroom, well, how can you maximize that space? Maybe you can open up the kitchen, right, to make an open concept. Maybe you can add a bedroom, right? Because, most of the time, your home is going to be lived in by a family, right?
Right.
And so they need that extra bedroom. They need that extra bathroom. And so those are the things that you can focus your energy, your time, and most importantly, your money on, maximizing to get that ARV.
Hey, can
Uh,
I ask you a question?
Absolutely.
Will it help to increase my value if I maintain them antique windows?
Oh man, threw me under the bus again. Man, listen. I thought them windows were nice. I thought
They
they
were
were
beautiful.
beautiful,
They were
historic
beautiful.
windows. And you
Yes.
know what? No, there's another feature that I
And how
focused
much?
on.
What was the quote?
Dude, man, homeboy was trying to quote me. So I got several quotes, right? I
Right.
got lots of bids, but they were ridiculous, right? To restore these historic windows, you know, I believe one quote off the top of my head was like $36,000. I'm like, what?
Yeah.
No, thank you.
Yeah. How about no thanks?
Um, but ultimately, I did restore some of them for far less than that. But again, right? I don't think hindsight is 2020. It always is. As a matter of fact, I know that that is not what affected the ARV. And so, maybe if I had just replaced them with energy efficient, I probably would have got the same ARV and probably spent far less money.
Yeah.
But anyways,
Yeah.
those are the mistakes, right, that we're going through, right, that we are still learning, and we're in it, right? We in the thick of it. We in the mud with y'all, man. So,
The moral of this story is like, you come into a house a lot of times as a rookie and you have these, you know, dreams that, hey, if I do this and I do that, everybody's going to appreciate this value. No, they
yeah,
ain't.
yeah,
There's
yeah, yeah.
certain things they're looking at: the kitchen, the bath. You already talked about
That's right.
that.
Yeah.
The garage, like the aesthetics of the house. Did you replace the siding or did you just power wash it? Right. Like, there are certain things I learned this on the rehab that we're currently doing right now is
Mhm.
you need to replace all those windows. Like if
Yeah.
a lot of these houses have single pane windows. Just
Yeah.
go to Home Depot and pick those standard windows up. They'll resize the hole, pop it in there, boom.
Yeah,
You got
man.
brand new energy efficient windows,
That's
right?
what I should have did, but
That's what you should have did.
we
But
we didn't do that.
we're talking about how to get that the best value for the appraiser, right?
Mhm.
So, we talked about getting that cheat sheet, making sure that you got photos. I always recommend, if you can, get professional photos after you have completed your job, right? If you can get professional photos, those photographers have a way of really presenting your home and
Yeah.
showing the beauty of the home. So, a lot of times before the appraiser actually goes to your house, they'll get access to the before and after pictures. So you're painting that picture, right? So we're talking about increasing the appraisal value. The other thing that I wanted to talk about was the home equity line of credit, right? And that's a whole nother
Yes.
segment, right?
Yes.
But, obviously you've got your DSCR loan. We talked about the traditional loan, the DSCR loan. Another opportunity is getting a HELOC. And
Yeah.
those
And
are
what's HELOC stand for?
home equity line of credit. So basically what you're doing is you're tapping into the equity value that's in the house, right? Ooh, I like
Right.
that. That sounds good. That shook me up a little bit. But the beauty about this is that typically it's not as expensive as getting into a DSCR loan, right? We
Yeah.
talked about all these expenses. You've got your broker fee, you've got your loan fee, you've got the underwriter fee, you've got this, you've got the appraiser fee, right? There are a couple of companies that come to mind. One is Figure and the other one is Better. Both of these companies have HELOCs that are available for rentals.
Mhm.
Now, you're going to find it very hard to find other banks that are lending on rentals. They'll lend a HELOC on your personal, but the rentals are difficult to come by. But what's beautiful about those is now you have access to this cash, right? So yeah, let's say you owe $100,000 and your ARV comes back at $300,000. Well, you can get 75% of that equity, get access to that credit line. So you can use a portion of that to pay off the $100,000. But let's say you have another $75,000 on top of that. You now can access that like a bank and pull from that equity. That becomes a powerful tool to help you to scale in the future if you
It's
use
like
it
a credit card.
properly.
Yeah.
Yeah, you got to use it properly. Now, what's crazy about these is that, yes, they are a little bit of a higher interest, but you typically have a 10-year draw period on an interest only product, right? That rate is variable. like right now, I was looking at a HELOC yesterday for, research for this podcast. It went from 8.5% all the way up to 9.5%, right? Depending on the amount of ARV that you're trying to pull out, or is it 75% versus 60% or what have you. So I would say that's a great option. The only caveat is that, again, this is something that's looking at your personal finances.
Yeah.
You're going to have to pull out your bank statements, your W-2s, and all that stuff. But if you can get into it, it's a great tool.
Super powerful too. And to also piggyback on that, Drew, if you have your property in an LLC, right, you're going to have to move it back into your personal name for
Right.
them to,
Hey,
so to
How do you
deed
do
it
that
back,
again?
right? So you're going to have to deed it back, warranty deed it back
Yeah.
into your personal name, which is not difficult, right? And certainly it's worth it, get a powerful tool like the HELOC, right? The
Yes,
home
sir.
equity line of credit. So yeah, man, that's a super powerful tool. And I'm glad you touched on that, because that's another thing that people can be considering when they're refinancing, and certainly when maybe the refinance doesn't go according to plan, like in my situation, and you might have to bring money to the table. So maybe, you do a HELOC to try to capture that equity that's in.
Yeah. I love it, dude. Is there anything else that we missed?
No, man, I think we kind of touched on it, dude. I think, I think we hit all the key points, dude. So, just to kind of recap, ladies and gentlemen, when you are ready to, hit this refinance phase and you see that finish line start to appear, make sure you are organized, and make sure that, you're organizing early, right? We showed you the spreadsheet. Do something like that if you want, or whatever works for you. But understand
We'll put a link to
also,
that in the show notes, right?
sure, yeah.
Yeah.
We can make that available. But also understand your financing options, right? Before you're under the pressure, right? So, as you're getting to the finish line, start looking at HELOCs, if that's is a tool for you. Start looking at the different DSCR products, and, start comparing them, right? And to
I
kind of
would say
see,
even before, like when you're talking about starting, I would say you should probably have an idea of what you want to
yeah,
do. What is your
for sure.
exit strategy before you even purchase, right? You need to figure out, you should have already gone through the process like we talked about in the third episode. You need to, was it the third episode or the second episode? The buy process.
Yeah, that was episode 3.
That was episode 3. So, you should have already put all that stuff in your spreadsheet about, what is my ARV? And if I do this, am I going to exit at a DSCR loan? Right.
Yeah. Right. And then, also prep for that appraisal, man. Be intentional about it, right? Have your pictures available, have the site cleaned up, do what you got to do, whether, you're walking the site prior to the appraisal, or you have your boots on the ground. Make sure everything's tidy, and ready to go, because that curb appeal matters, right? First impression matter when it comes to appraisals. And, kind of lastly, I'll end with this is, make sure that when you are forcing this equity and you're trying to get that ARV to the top number based on the comps in your area, that you are rehabbing it accordingly, right? You are doing that kitchen, you're doing the bathrooms, or you're adding bathrooms, or you're adding and opening up the kitchen. You're replacing those major appliances like HVAC and plumbing and electrical, and, installing new appliances and things of that
And
nature.
getting rid of them ancient windows.
And getting rid of them ancient windows, man.
Yo, check
Oh,
this out.
terrible.
If this
Terrible.
helped you out, send this to someone in your circle who's trying to get their money back out of a deal. We
Yeah, man.
all are trying to grow together. We're trying to
Good.
bring you guys some value here. If
Yes,
you
sir.
got value, let us know.
Yeah,
You
man.
got to subscribe. You got to like. You
Yeah.
got to share.
Oh, Drew, we got a new
What?
segment, dude. We got a new segment, man.
What's
It's
it called?
Ask the brothers, man.
Ooh,
So
okay.
listen,
All right.
if you have, like he said, if you have questions for us, hey, maybe you want to be featured on the show, no matter
Boom.
how deep your question is or how light your question is, it really don't matter, man. Ask the brothers and we'll go through it,
Brothers.
right? We'll answer your questions live on the show, man. It's gonna be great, dude.
And we'll even impersonate Mike Tyson.
Mike, sorry, Mike, man. I don't know why we picking on you, champ.
I love you, Mike.
Hey,
I love
man.
you.
So
Hey,
listen,
Mike, you want to be on the show?
yeah,
Ask the
look.
brothers.
Look, man, we encourage you guys, right? Start a folder, email a lender, right?
Yes.
Prep your appraisal story today, and
Get your spreadsheet together.
yes, sir. Yes, sir. Yes, sir. So, Drew, man, any final words for the people?
Hey, we appreciate you, and thanks for listening to all this banter back and
Yeah.
forth.
Yeah, man. Yeah. So next week we're gonna touch on the final part in the BRRRR process, the repeat, right? Where you can repeat this strategy over and over again without the burnout so that you can scale your portfolio and keep that momentum going without losing your mind, really.
Yes.
So
And in a couple weeks, man, I think we're gonna be featuring Jabez, right? We're gonna be bringing some fun stuff to you guys.
Dude, that's gonna be dope, man. When we do that, man, that's gonna be real
Yes.
dope. So, anyways, people, man. So, ladies and gentlemen, we're thankful, man. So, follow us on Instagram, follow us and like, subscribe, share, please, on YouTube and Facebook and TikTok, of course. So, for my cousin, for the numbers ninja, for Drew, I'm Jordan, and we are
the Property Brrrrothas.
Peace, y'all.
The Property Brrrrothas.
The Property Brothers was produced and edited by the hosts. All rights are reserved by the Property Brothers LLC, and the hosts are operating exclusively on behalf of the Property Brothers LLC. Please consult appropriate tax, legal, real estate, financial, or business advice. Nothing on this show should be considered professional advice. We appreciate you all for following our journey. It would mean the world to us if you could like, subscribe, and leave a review wherever you listen to podcasts. God bless.